Warren Buffett is arguably the most successful investor to ever live. Since during his long investing career, he has managed to achieve an astonishing 20% compounded annual return for the last 60 years. Meaning that if you have invested in his company Berkshire Hathaway instead of the S&P 500 index fund that tracks the performance of the US market, you would have produced 140 times higher return on your investment. So he claims that his astonishing success was primarily a result of him following his robust investing principles. But regardless of that, there were situations where he simply took the wrong investing decision, which harmed the compounding of his portfolio. So in this video, I'll go through his most notable investment mistakes and analyze what caused them and how you can avoid them in your own investing journey. As the saying goes, it is great to learn from your investing mistakes, but it is even better to learn from the mistakes of others, especially someone as legendary as Warren Buffett. The first most prominent mistake he made was in the year 1993 when he decided to invest in Dexter shoes. And in the year 2000, in his letter to shareholders, he wrote, "I clearly made a mistake in paying what I did for Dexter in 1993. Furthermore, I compounded that mistake in a huge way by using Berkshire shares as payment." He follows the letter by saying that he charged off all the remaining accounting goodwill that was attributed to the Dexter transaction. So even though on paper he paid $433 million worth of Class A Berkshire Hathaway stock, today that stock is worth more than $17 billion.
Yeah, we lost a very significant amount of money on Dexter thanks to a dumb decision that I made, and maybe several dumb decisions.
So how did Buffett allow that to happen, given his robust investing principles of searching for companies in which he has good understanding of their business and their industry? Well, he simply fell into the trap of something commonly found in people called availability heuristic, which is a mental shortcut where people judge the likelihood of an event based on how easily instances or examples come to mind. What I mean by that is that Warren saw a company within an industry that he has been successful in on multiple occasions in the past. This is because just 2 years earlier, in 1991, Warren Buffett acquired a company called H.H. Brown through his Berkshire Hathaway. And H.H. Brown proved itself to be a huge investment success. And the following year, in 1992, he purchased another company named Lowell's Shoe, and the success of this acquisition was almost immediate. So it wasn't a surprise that in 1993 he bought a company in the same industry, which was Dexter Shoe. However, Dexter Shoe had one big difference compared to the other two shoe companies. Both H.H. Brown and Lowell Shoe had the majority of their manufacturing abroad, primarily in China, where the labor was extremely cheap. However, Dexter Shoe had its entire manufacturing in the US, and it turned out that the company did not possess the same economic moat as the other two companies. So the company got decimated by the tough competition of Chinese manufactured shoes, which use much cheaper materials and labor.
That is a business that went offshore in a huge way. The textile business, as you know, has gotten almost destroyed in this country. If you're paying 10 times as much per hour for labor as somebody else, it's awfully hard to do that good.
Similarly, another notable example is a mistake which Buffett described in his 1994 letter to shareholders as a case of a sloppy analysis that I was neither pushed into investment nor misled by anyone when making it. He had to write down the company's worth 25 cents on the dollar in the same year, meaning that the company's value declined by 75% since he purchased it 5 years before in 1989. And it was the airline company US Air, later renamed to US Airways, which Buffett invested $358 million in. In that same letter to shareholders, he mentions that he made that mistake by not following one of his principles, so he wrote, "In an unregulated commodity business, a company must lower its costs to competitive levels or face extinction. These principles should have been obvious to your chairman," meaning himself, "but I missed it." So his self-proclaimed sloppy analysis means that he wasn't able to assess that the company's high costs will result in a business that lacks competitive advantage, which is very similar to the mistake that Buffett made when he was investing in Dexter shoes. A more recent mistake that Buffett made was regarding the American multinational food company Kraft Heinz, where Buffett mentioned this about the investment in an interview.
Was that a mistake?
Well, we'll find out over time, but we did pay too much, in my view, for Kraft. We didn't pay too much for Heinz. Then there's not much you can do about things if you pay too much.
Now in Kraft Heinz's case, Buffett acknowledged he was wrong in a couple of ways. One of them being connected to Warren's Berkshire Hathaway and another major investment fund called 3G Capital, who together orchestrated the merger between Kraft Foods Group and Heinz Co. in 2015 to create Kraft Heinz. However, arguably the biggest error that Buffett made when he decided to make this investment was that he simply overestimated the future growth of the company. This was caused primarily by not accounting for the shifting consumer preference towards healthier alternatives, which resulted in a major slowing down of the company's revenue growth. So the main reason for this mistake was that the company's brand moat eroded due to changing consumer preference. This clearly shows that some moats, even if they seem permanent, may turn out to be vulnerable, especially when the company has a lack of industry adaptation or innovation. So be aware when choosing your next investment. Regardless of the industry, if a company is not willing or not able to adapt, it is only a matter of time before it will be replaced by a competitor. So far, we discussed some major investment errors that Buffett made when deciding to invest in these businesses. However, he claims that these are not the worst type of mistake he has made during his investing career. So let's hear from him what they are.
The biggest mistakes we've made by far, I've made, not we've made, biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb. Those are the big, big mistakes, and I've had plenty of them.
So you heard him right. The biggest mistakes that Buffett made was not the ones where he slightly miscalculated the future growth of the company or overestimated its competitive position on the market, but rather businesses that he understood well and were within his circle of competence, but he still didn't take the decision to invest in them. The first such company was one where Geico, which is an insurance company owned by Berkshire Hathaway, was a client of, and he clearly understood how good of a business model it is, but still missed to invest in it because he wasn't convinced that its competitive advantage will be as durable as it currently is, and that company was Google.
Well, I should have had some insight into, because Geico was a heavy user very early on. So here we saw value in something at that time. I have no idea what we're paying per click now, but we were paying $10 or $11 a click for something that had no cost of goods sold, and we were going to keep doing it. I mean, we could see that. So it's a hugely valuable device, which the other guy pays for. The user of the computer doesn't. The answer is we missed it.
So in this clip, Buffett acknowledged that he missed an opportunity that he understood well enough to execute on, which in his words was way more impactful compared to the mistakes of commission that he has made previously. So is this the only major opportunity that he acknowledges to have missed? Well, no. Through the years, he has mentioned this either in his annual letters to shareholders, Berkshire's annual meetings, or in some interview about companies that he understood well and still missed out on. But there is one specific business which has had an astonishing performance in the market that has become the leader in not one but two industries that he claims to have missed because of ignorance. Let's hear him tell us about it.
How come you don't buy shares of Amazon?
Stupidity. I was impressed with Jeff early. I never thought he could pull off what he did. And the remarkable thing about Jeff and everything else is he's done it in two industries almost simultaneously that really don't have that much connection. I've never seen any person develop two really important industries at the same time.
There is one final financial mistake that I want to mention, and it is probably the most important one. The reason being is that it was not committed by Warren Buffett, but by his own teacher Ben Graham, also known as the father of value investing. He is the writer of the famous book praised by Warren Buffett named The Intelligent Investor. Warren Buffett learned everything he knows about investing from him at Columbia University, and Ben forever changed the way Buffett thinks about stock market investing. So just before the Great Depression, Ben Graham decided to put all of his money into the market. So when the depression came in 1929, the market fell substantially and Graham's portfolio fell with it. So then in 1930, he decided that the market is undervalued and wanted to invest even more in it. He was probably right about the market being cheap, but he made a grave mistake, and it was that he decided to use leverage, since he had already invested all of his money into the market. And through the following years, he had wiped out 70% of his investing portfolio. The truth is that no investing style is immune to the short-term fluctuations of the market. So the conclusion is simply that a value investor should never use leverage, since it can easily destroy anyone's long-term portfolio.
I pointed out that there have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred, but
these mistakes have been crucial in developing Buffett's investing principles, which led to the tremendous investing success that he has achieved. But it is even more important for you as an investor to learn from his past mistakes so that you can avoid them during your own investing journey. So if you want to learn how to outperform the market consistently like Warren Buffett and other legendary value investors like him, check out these videos where I explain their investing approach in details.